Let's talk about this deal, the prospect of an IPO that some people thought we might not get at all.
Sure, yeah. I think this is a textbook case of how to make unforced errors and lose the narrative right off the gate. That's what's happening. This is a reasonably good company with good assets, but the valuation is off price. Too many red flags on the corporate governance side. So just too many unforced errors at a time when they want $47 billion. That's what it was in the last round. So priced for more than perfection. So, I mean, you can't make these errors when you come out.
Let's talk about that last funding round, shall we? $47 billion, SoftBank coming in with a couple of billion. A huge drop down to what some people see now as potentially 10 to 15. Surely that is not just governance issues. That is way more than just governance issues, don't you think?
Yes, absolutely. I think it should never have been priced at $47 billion. I think that's a whole different story. I think just in January of 2019, SoftBank bought back shares of employees at $20 billion. And so it's really in the 20 to 25 billion. It can be justified, provided they clear out the corporate governance issues and give more clarity in terms of their financials. Right now, we don't know much. They just want us to go on faith and just on the belief that it's a good business, but we need more clarity on what the real fundamentals are.
You have helped facilitate transactions in the private markets for investors that would like that kind of access. Santosh, I just wonder to what degree you think from where you're sitting that SoftBank has really distorted valuations across the whole space. To what degree is that true?
It is very true. I think with so much funding available, I think valuations got ahead of themselves, and the companies were valuing more, and even the public markets were pretty gung-ho overall. So I think that kind of fed into the private markets as well. But overall, I think SoftBank has kind of corrupted, I can use that word, loosely. Loosely, the private market valuations. They need to, and I think overall, at the end of the day, I think WeWork has done a big favor. I think now the public markets and the private markets are going to be very careful. It's not going to be any more free pass. You need to justify where you are, where you're going, and what your valuation is.
You really believe this could be the beginning of a pushback around corporate governance issues?
Absolutely. I think the bar was being raised. You still have here 10 to 1 voting rights. Okay, let's grant that, but I would prefer they have a sunset clause. Maybe in 7 years it goes back 1 to 1, something like that. They need to do a lot to convince people, convince investors on the roadshow that, hey, we're playing it right. No more of this self-dealing appearance. It's all cleaned out. The CEO is totally accountable, and that's what we want. So that's what's going to happen.
What about the valuation issues? So many people spend so much time focused on public markets, and that's because there are so many people operating in public markets. Yet at the same time, this is an example that perhaps the froth was never in public markets. It's in private markets. Is that going to get addressed?
Yeah, I think it's definitely going to pull back now. I think the private market valuations are going to get more rational. See, I think you have to really value this company on, there is a case to be made for 20 billion, around 20 billion. So let's say by 2023, according to my model, they come about 19 billion in revenues. That's a time when most of their properties will be mature, which is they'll break even on a contribution margin basis. So then if you discount that back, give it like 1.5, very conservative 1.5 times sales, and then discount it back to today, you can get to around 19 to 20 billion. That's as a baseline case. 15 billion, 10 billion is very, very conservative, very strict. I think they need some credit. They've done a great job. It's a growing market. The flexible space is only 1% penetrated of the total office space. So there's big runway ahead, but we have to see how they can become profitable.
Let's pretend they had no corporate governance issues whatsoever. You believe this is a viable business?
It is. It can be down the road. We have IWG. Unfortunately for WeWork, there is another company out there. Unlike Uber and Lyft, where there was no precedent, so you had to really go on that transformation story, which they are. But here you had IWG that struggled, but finally is profitable. It's been around since 1989. So there is some precedent. So I think investors will hold them to that valuation. So that if you take that and give them this credit, they have much better properties. WeWork does. So you can give them some premium there. So net, I think you can treat it slightly better than IWG.
What do you think the valuation is at the end of this roadshow, once all is said and done?
I think it's going to be closer to 20 billion.
Really?
Yeah. I think that's my guess. I can justify that. We're not buyers of this. We never invested in this. We believe it's more a real estate play than a tech play. So we didn't really get into that. But we did look at it. It's a good company. I mean, it has runway ahead. It deserves some benefit of doubt, but not too much. But let it execute. They have a good vision. But maybe the starting point has to be like 15 to 20 billion.